Good morning, everyone. My name is Doug Paul. Welcome to the Carnegie Endowment for International Peace. We're gathered this morning to, as you very well know, to talk about the big issue in China of rebalancing the economy, shifting China's economy from an investment-driven one to the stated, at least often stated goals of the Chinese government that the economy should be driven more by consumption. And certainly that's been the hope of the G20, the United States, and many other participants. This morning's, we've got three superb panelists to discuss this issue in considerable depth, and I don't want to get in the way of their presentations. We're hosting today from the Deputy Division Chief from the Asia Department of the IMF, Dr. Stephen Barnett, who will be leading off this morning, followed by Peter Botelier, who is at Johns Hopkins SAIS, longtime representative of the World Bank in China, and has also got an affiliation here with Carnegie. And our final speaker will be Michael Pettis, who's a professor of finance at the Guanghua School of Management at Peking University and a senior associate here at Carnegie Endowment as well. I don't think I have much more to say other than to let Stephen, please charge ahead.
You wanted to move?
Would people please turn your cell phones and other devices off so we don't have interruptions? Thank you.
It's me too.
All of us.
Okay, well, thank you very much for inviting me today. It's truly an honor and a pleasure for me to speak here today. Let me cut right to the chase and give the conclusions right away. So I'm going to make 3 points in this quick presentation. The first is that rebalancing the economy remains a top priority and that it requires a comprehensive package of reforms. And in my talk today, I want to talk about some of the reforms that we talk less about. And I want to focus on things like financial sector reform and liberalization, social security reform, increasing the size of the service sector, and reducing corporate savings. That's the first point. The second point is that actually if you look at the thrust of the authorities' policy plan, it has all of these aspects in there. Maybe the pace isn't quite the same as what we're pushing for, but the thrust is there. I'm not really going to speak to that, but you'll see in all my slides I have quotes at the top. Those are all from Premier Wen's recent speech at the conclusion of the opening of the MPC meeting. And those quotes all reinforce the points to illustrate that the thrust of the authorities' policy advice is the same. And we were asked to speak briefly on overheating. I have just one slide on the end. And the bottom line is, at this time, we do not see signs of generalized overheating. At the same time, though, we welcome the tightening of monetary policy, which really could be seen as a normalization of monetary policy, and the gradual withdrawal of fiscal stimulus. So what do we mean by rebalancing? Well, basically it means increase the reliance on domestic consumption as a driver of growth and be less reliant on exports and investment. This chart on the left shows the export growth. It's an index, so we look at the period of rapid growth in exports for several Asian economies. And China is the red line in this chart. And basically China's export growth is really not phenomenal when compared with Korea or the newly industrialized economies. However, China is big. So when we look at terms of market share, this is the graph on the right, the red line. China's market share in selected economies is actually already quite high, approaching what Japan saw. And some research by my colleagues, Kai Guo and Papa Ndaya, they conjecture, well, what if China exports continue to grow at the current pace? And this is the red line that's rising to the top of the graph, hitting the word since, which suggests that their market share would continue to rise and approach over 16% in these selected economies. And they basically ask the question, is this feasible? Is this sustainable? And they wanted to do this, China would have to increase relative productivity to keep costs low, and they'd also have to squeeze profit margins. So it really begs the question whether this is sustainable. And again, the Premier Wen even says it's about sustainability. This chart here shows the current account surplus projections from the last IMF staff report. And this was published around July or August of 2010. The blue line was the staff projection at that time. And the bottom line is we were projecting, and are continuing to project, that the current account surpluses would reemerge. And so we've seen a sharp decline in the current account surplus. Actually, it's been cut in half from 2007. When we look at these projections, to kind of cross-check, we thought, well, let's run some models to make sure, see what the models would say. And basically, these two panels, the left is a Bayesian VAR, the right is this GIMP model that the IMF has. And actually, the models were projecting an even faster recovery in the current account surplus than we were projecting. So we did these projections in the summer of 2010. How did we do? I would argue, actually, our projections were pretty good. So 2010, the current account surplus we were projecting was 5% of GDP. The actual outturn was 5.2. And although it's a bit confusing, the actual outturn, if you make some accounting adjustments and some other adjustments, was even stronger than we thought. You know, two things happened. One, China changed how they account for income on FDI. They basically improved the statistics. This actually caused the current account surplus to be roughly 1% of GDP smaller. So that would add another 1%. Had we known that, we would have been projecting 1% of GDP lower. So in fact, the surplus was stronger than we thought. The second thing was the terms of trade really moved against China. That is, commodity prices really rose. Had we known that, we would have projected 0.5% of GDP smaller. All in all, a very long-winded way of saying that actually the current account surplus in 2010 came in stronger than we expected. When we talk about rebalancing, we also talk about switching from investment to consumption. What this chart shows is how China compares globally. And we see that the chart on the left, that consumption as a share of GDP in China is quite low. In fact, it's the lowest in the sample of countries. And here we've averaged over 5 or 6 years to control for business cycle effects. Chart on the right shows that investment as a share of GDP, you can see the red dot, China's way at the top there, is high. So when we talk about rebalancing, we're talking also about moving from investment to consumption. The fact that China is low in consumption and high in investment, I don't want to push this argument too far. It doesn't say what's the right level for China. It just says it provides some international context. Let me start here with the chart on the right, which shows the rising household savings rates in China. And I'd like to focus on the green line. This is from the household survey data. And this is the urban household savings rate. And we see over the last decade, household savings has risen from 20 to 30% of GDP. The rural picture is a bit more confusing, but urban households account for the bulk of consumption. So they're driving the aggregate story. So one of the key policy focuses is how do you decrease the savings rate? And one way is to reduce precautionary savings. The idea is that households in China kind of oversave because they have to self-insure. They have to self-insure for their pensions, they have to self-insure for education, and self-insure for healthcare. So some research actually that I did with Ray Brooks, we were both in Beijing together as resident representatives, kind of asked the question, do we find quantitative evidence for this precautionary savings, as it's called? And actually we do. We found that for every 1 renminbi the government spends on healthcare, private urban consumption increases by 2 renminbi. This is a very strong effect. This underscores that the precautionary savings role could be quite important and that strengthening the social security system could help to reduce precautionary savings. Here, another thing I would add is in Premier Wen's work report, he cites that not only are they going to try to extend basic medical care to everyone, but that the goal is to increase the reimbursement rate to 70%, which actually is quite important for reducing individual uncertainty. Not only will we have access to health care, but the government will pay 70% of the costs. The chart on the left shows that the second fact, which is maybe a little bit less well known, that household income has just not kept pace with GDP growth. And this shows the ratio in per capita terms of rural and urban household income as a share of per capita GDP. And this is the graph on the left, and it's been falling steadily. Frankly, dealing with this is a little bit trickier. And if you look at what's caused consumption as a share of GDP to fall, I would argue that this household income declining as a share of GDP, that is households getting a smaller share of the pie, is actually kind of quantitatively more important. Now, one option for increasing this might be to decrease Social Security contributions. Right now in China, the combined employee and employer contributions are in excess of 40%. This is for the contributions for pensions, unemployment insurance, healthcare, and that this is actually reduces wage income, and it's a deterrent for investment in labor-intensive industries. It makes capital relatively cheaper. Another option could be to change relative prices, such as the costing of energy, water, land, and pollution. This would also kind of switch the, make investment in labor-intensive industries more favorable. This chart's a bit confusing. There's a lot of lines, but it shows the growth rate in consumption and the growth rate in per capita household income. The main point of this chart is, we talk about these ratios as a share of GDP falling, but let's not forget the growth rate in an absolute sense has been very, very fast. Household consumption in China has grown very, very fast. So has household income. It's just not grown as fast as GDP. So another way to increase the share of income going to households is to increase the size of the service sector. Why? Well, service sector tends to be more labor intensive. Therefore, naturally, labor will get a higher share of income if the economy is more reliant on services. Again, I'm stealing from some other work done by Kai Guo and Papa and Daya. In fact, it's all collected in this recent IMF book on rebalancing growth in Asia, which I think was promoted here a couple weeks ago. But they asked the question, is the service sector kind of too low in China? And this is the graph on the left. They run this model, and the light blue line shows what the model predicts based on per capita GDP for the size of the service sector. And then they've labeled what Japan, Korea's experienced, the US experienced. Then you look at China on the far left. Basically, the size of the service sector in China is below what the model predicts. And this could be one important factor explaining why households get a smaller share of income. The service sector needs to grow. The good news is that this is featured prominently in Premier Wen's work report. In fact, one of the quantitative targets is to increase the value added in the service sector by 4% of GDP. Although if we look carefully, he also mentions that 2 of the 3 targets missed in the 11th five-year plan related to this. One was that they did not increase the share of the service sector like they wanted, nor did they increase the share of employment in the service sector as they had envisaged in the 11th five-year plan. The chart on the right shows a modeling attempt to look at, well, what happens if China actually succeeds in moving from the tradable sector to non-tradables or the service sector? What happens to employment? And the green line shows the model simulations of what happens to total employment. The bottom line is there could be some adjustment costs. 2 or 3 years out, it could be the case that employment is a little bit lower. But over the medium term, employment would actually be higher. So this shift, although there could be some adjustment costs, would actually be good for employment over the medium to long run. Lastly, on financial sector reform, this chart on the left shows the benchmark 1-year lending and deposit rates, and then the green line is the ex-post inflation rate. So if you take when the green line is above the red line, you got a negative real return on your deposits. That means inflation 1 year ahead, if you had perfect foresight, was greater than the deposit rate. And we actually see for much of this period that was the case. Real interest rates were negative. And that this actually has a big bearing on both household behavior and corporate behavior. Corporates in China are very cash rich. So if a corporate's faced with a negative real interest rate on its savings, the capital account is fairly closed, there's few options, investment looks pretty attractive. Moreover, it also speaks to why investment in real estate is attractive. It's a very good financial asset, given that there's not too many other assets out there. In terms of the behavior of households, this chart on the right tries to look at, well, what was the impact of this negative real interest rate on deposits on households? The red line shows household deposits as a share of GDP are big. They're about 75% of GDP. So if you're getting a negative real return, the blue bars show as a share of GDP how much did households lose each year. In the last couple of years, households lost more than 1% of GDP from keeping their money in household deposits. This is the real return. All this points to the fact that financial sector reform and deepening could go a long way to rebalancing. It could help discourage investment It could help households increase consumption. And we talk about financial sector reform. It's not just the banking system. We also have in mind things like the insurance market, creating annuities, fixed income products, mutual funds, all of these things to give households more alternative assets to invest in. And my last slide on overheating. I think our take is that indeed inflation has risen. I think that this only goes through January, but February's outturn's quite a bit similar. The chart on the left, the blue line shows headline inflation. But then if we strip out food prices, that's the red line, inflation's up, but it doesn't look quite as high. And the bottom line is much of the increase in inflation has been driven by food prices. This spike in food prices can largely be traced to supply shocks to food. So we do not see the inflation as being indicative of generalized overheating pressures. Nonetheless, we welcome the tightening of monetary policy. That is the hike in required reserves, the raising the benchmark lending rates, and the general effort to contain credit growth. But one way to view this is sort of a normalization of credit conditions. This graph on the right, these bars, show what was the extension of credit as a share of GDP. And the axes are right, that in response to the global financial crisis, the increase in credit as a share of GDP was 30%. That is 30% of GDP in new credit went out the door, and this was obviously instrumental in helping China weather the global financial crisis and spawning the quick recovery. But now that the economy is recovering, it's time to normalize this, and we can see that's been happening. Those blue bars are shrinking. The red line is the year-on-year credit growth. We see that credit growth is declining. At the same time, we also welcome the 2011 budget, which starts this process of a gradual withdrawal of fiscal stimulus. And I'll stop there. Thanks.
Well, thank you, Stephen, for that survey of the trends. We now turn to Dr. Peter Botelier to present his take on how China's doing at rebalancing.
Find it first. The credit growth numbers, was that the new total social financing numbers or the new loan numbers? And I need some technical help. Get out of here. Doesn't include equity. Just alternative forms of equity. I'm sorry to eat up your time. Before I show you my slides, some of which are actually very similar to Steve's, let me give you my bottom line, my conclusion. The fact that China's economy is very unbalanced and the fact that the Chinese economy is very unbalanced, that the growth pattern is unsustainable, is very well known to the authorities. It's the central theme of the 12th five-year plan that was adopted earlier this month, as Stephen mentioned. It was already an important theme in the 11th five-year plan, which started 5 years ago, but there's no evidence of any progress during that five-year period towards the rebalancing objectives. Oh, okay. My contention is that one of the reasons why things did not improve at all during on that aspect in the preceding 5 years, one of the factors is the international financial crisis, which put some of these policies in China in reverse gear, particularly with regard to the exchange rate, but also the fantastic increase in government-sponsored investment to respond to the crisis and revive the economy, I think did very little to help the rebalancing picture. Looking ahead, I'm moderately optimistic that things will begin to improve in the years ahead, and I will explain some reasons why underlying my moderate optimism. I'm more confident, I think, that the No, let me precede that. There are two basic metrics for balance that economists look at. One is the share of consumption in GDP, which in China's case is extraordinarily low, particularly the household consumption, and has been declining. The second metric is the share of current account surplus in GDP, which admittedly has been declining since the peak in 2007, but for reasons that have more to do with the international crisis than Chinese policies. On the first metric, I'm reasonably confident that things will begin to improve. I don't know when, but there are strong reasons to believe that the share of consumption in GDP in China will increase. I'm less confident, less sure about what will happen to the trade balance and the current account surplus. The IMF shows consistently a deterioration of the situation, that is an increase in the current account balance as a percentage of GDP, as you saw in some of the slides that Steve presented. I'm not so sure that that's the correct perspective, but I'll explain you why there are some reasons to doubt the IMF projection. So let me, if I can. This is the familiar picture of what happened in the last few years in response to the crisis. If I can use this fancy. This is the miraculous, absolutely fantastic recovery from an almost 0% growth in the last quarter of 2008 to an over 15% growth quarter on quarter, calculated on a quarter on quarter basis in the first quarter of 2009 already, in the second quarter of 2009. So that has not happened to any major economy, this kind of stupendous, astonishing recovery. It's all due, quite frankly, to this tremendous expansion of government-sponsored investment, infrastructure investment in particular, and that was mostly credit financed, as the next slide shows. This is, I think this is a repeat of a slide that Stephen showed. This is the fantastic expansion in bank credit in 2009, and again, certainly in the first half of 2010, which really is the secret underlying China's quick recovery. In my opinion, that credit expansion was excessive. I don't think the government intended it to be so high. It went out of control, and it led inter alia to the fact that in the last 2 years, 2009 and 2010, M2 growth, the broad money indicator of money supply, grew almost twice as fast as nominal GDP, which means that as a result of that, there is now something that we might call a huge monetary overhang in the Chinese system that explains the enormous inflationary pressure that we are now experiencing. This is a slide on the lending rates as opposed to the deposit rates that Steve showed. This whole crazy lending in China that went on in the last few years was, of course, stimulated in addition by a falling real lending rates to almost zero in the last few months of 2010 and the beginning of 2011. With almost free money in China, it's not surprising that everybody took advantage, including local government and their platform companies, to get as much as they could get hold of. This I already explained, the two metrics of imbalance that economists look at, current account surplus and share of consumption in GDP. And I think I mentioned that the first ratio, I'm less confident about what's going to happen. The decline since 2007, mostly due to the sharp contraction in global trade. There's some uncertainty as to what happened in 2010. There was an announcement on the website of SAVE indicating that, in fact, the current account surplus sharply increased in 2010 over 2009, which is not what you showed in your statistics, but that remains to be confirmed. That's a provisional announcement on their website. I haven't seen anything published yet. So we have to keep an eye on that. On the consumption rate, as I will explain later, I'm a little more optimistic that things will begin to improve. This is simply the current account surplus as a percentage of China's GDP. And this uptick here in 2010, contrary to the downtick in Steve's, is based on provisional information that came out of the SAFE, and that needs to be confirmed. I hope they were wrong, but I don't know. This is also a familiar illustration of the decline and very low level of household consumption in China's GDP, which in 2009 fell to about 35% by my estimate. The blue line is the average for high-income countries, which is well above 60%. In the US, as you know, it has been 70% in recent years, which is too high. European average is about 60%. This, I think, is to illustrate that even though the Chinese economy is very unbalanced and the share of consumption in GDP is much too low by international standards, it's not the rate of consumption growth in China that we can point to as the major factor underlying it, because China's household consumption growth is, in fact, paradoxically, the highest in the world. This is one of these strange things. So if it was not the slow rate of household consumption growth that explains the unbalance, what is it? Well, the explanation lies, in fact, in the excessively high investment rate in China, which has been growing even further above the already very high level of 40% to almost 50% in recent years. And in 2010, it may have in fact hit 50% once we get the final numbers, which is off the charts. There's no other economies in the world that have such a crazily high investment rate. And of course, much of that is government-sponsored investment, and much of that is financed with bank credit, which is, I think, the real story underlying this very unusual story. Now, reasons why I believe that the share of consumption, household consumption in China's GDP may turn around, may have bottomed out and begin to creep up in the years ahead. I don't know exactly one. One factor already emphasized by Steve, employment in the service sectors. Service sector growth is now pretty high in China. The share of services in GDP is still very low, but the growth rate is very high. And employment growth in the service sector is much higher now than manufacturing, since the level of education and income in service sectors everywhere is higher than in manufacturing. We must expect that the share of household income in GDP has bottomed out in China, or is about to bottom out. And from then on, I think we can be a bit more relaxed about predicting an increase in the share of consumption. A second factor is consumer finance, which was almost non-existent 20 years ago in China, is now very rapidly increasing, accounts already for a substantial share of bank lending. A further factor is also mentioned by Steve, that government spending on health and health insurance subsidies is rising very rapidly. And as they showed in their chapter in that wonderful little book, could you hold it up? That's, I recommend strongly chapter 7 in that book, econometrically proves that when the government increases its spending on health, the need for precautionary savings drops very sharply. Demographic aging in China is another factor. In traditional China, the care for elderly was a family responsibility. That's because of the one-child family policy going to be increasingly difficult. And I think this will be the subject of commercialized services. Care for the elderly will become a large sector of the service sector industry, and that will grow like crazy in the decades ahead. And demographic aging is the factor underlying that. Finally, very important, the real exchange rate, which was one of the factors that I think fueled the unbalanced nature of the economy, is now appreciating very rapidly. As Secretary Geithner pointed out just a few weeks ago, he calculated that the real exchange rate of the renminbi relative to the US dollar is appreciating currently since the middle of last year at least 10%. If you go on for it like that for another 2 years or so, at least the real exchange rate will cease to be undervalued very quickly. Finally, a point that came out of all the announcements from the 12 5-year plan, China is planning a major revision of its personal income tax system with the objective to reduce social inequality and enhance private consumption. On the other factors, why I'm on balance inclined to think that things will improve in the years ahead, barring major disasters that will require a reversal of policies, of course, as happened in 2008, are that the awareness of these problems is now pretty strong at the top levels in Beijing. You don't see a major speech without a lot of emphasis on these subjects. Second factor is China is pushing very hard to increase the domestic value added in exports. Since processing trade is 100% responsible for China's trade surplus and a large part of the current account surplus, if this policy goes ahead and the share of domestic value added in export increases, all other things being equal, there's reason to expect that the trade surplus will actually begin to fall in the years ahead. In fact, I wouldn't be surprised if this trend, because that 5 or 10 years from now, the entire situation will have fundamentally changed, and China may have become a net capital importer. That's a sort of a remote point at this thing, and rather fantastic. But should that happen, world capital markets will change fundamentally, and the cost of capital globally will go up very much. The fact that because of the inflation pressure, there is continuing need for further monetary tightening in China will probably drive up the real cost of money. That will have the effect of, all other things being equal, slowing down investment growth and creating room for private consumption growth. Since investment growth, excessive investment growth, is the root cause of the imbalances in China, I think this is an important factor. Finally, President Wen Jiabao announced very publicly that the growth target for the 12-year plan was reduced to 7%. That's an important political announcement, because if you combine that with the plan to modify the incentive framework facing government and party officials at the local level, it provides cover for those who want to prioritize social development and environmental protection. That political cover for local level officials provided by that 7% target, which is lower than anything we have seen in recent years, is very important. All these reasons together lead me to be moderately optimistic that things will begin to improve in the years ahead. Thank you.
Thanks very much, Peter, for a really succinct and clear presentation. It makes me wonder, as someone who's watched the politics of China rather than the economics, how these outcomes, these more benign outcomes, will look to people as they get ready for a political year in China, when you want to keep all your supporters behind you and you want to have as many friends as you can possibly have before you go into the party congress. And if these objectives are incompatible with the political outcomes they're seeking. I would turn now to Michael Pettis, who's visiting from Beijing. And Michael, it's all yours.
It's probably a strategic mistake to have me speak last, because I'm the pessimist. So it was better to start with the pessimist. I think China is going to rebalance over the next 5 years, and by rebalancing, I mean, of course, that household consumption is going to rise as a share of GDP. I think they have no choice. The external environment is not going to permit anything else. But I think we should discuss, first of all, the magnitude of the problem, and secondly, the ways rebalancing can take place. The magnitude of the problem is enormous. You know, 5 years ago, when consumption was about 40% of GDP, it was widely acknowledged that that was an extremely low rate, an unacceptably low rate, and it forced China to rely too heavily on investment and on the trade surplus for growth, which, as you've seen from my two colleagues, has been the case. And this was 5 years ago, during a period in which Chinese underconsumption was more than matched by the happiness with which Americans and which peripheral Europeans were willing to make up the slack. Don't forget, in both peripheral Europe and in the United States during that period, household consumption was growing much faster than GDP. So it balanced with China. So let's give China a very, very low bar. Let's say that they have 5 years to get back to 40%, even though global conditions in 5 years, I believe, will be much more unfriendly, much more unfavorable than they were 5 years ago. But we'll give China a very low bar and allow it 5 years to get to 40% household consumption. Well, that means basically that household consumption has to grow by around 2.5 percentage points higher than GDP, right? That's just a mathematical number. And what would that mean? If Wen Jiabao is indeed correct in saying that GDP is going to grow by 7% over the next 5 years, which frankly I think is optimistic, that would mean that household consumption will have to grow by around 9.5%. So we have sort of very interesting dynamic. We will have over the next 5 years the lowest growth rate that we've had in the last 30 years, but we also require by far the highest consumption growth rate that we've had in the last 30 years. That's going to be quite difficult to do. Now, remember what rebalancing means. It simply means that consumption growth has to outpace GDP growth. And there's many ways we can do that. The golden way, the good way, is if we do whatever steps are necessary to get consumption to surge. So if we can get consumption to grow by 9.5, 10, 11%, we can have very high GDP growth rates and still get to our very low target of 40% in 5 years. But there are other ways that this can happen too. For example, we could have 5% growth rates. We could have 3% GDP growth rates and household consumption growth rates of a couple of points above that. We'll still get to our rebalancing target. So the question is, which is the likely outcome? Which is the likely path? And here is where I'm fairly pessimistic. But rather than describe my pessimism, what I thought I would do is talk a little bit about a debate that's taking place, which has really emerged more strongly than ever in the last couple of years between a group broadly called the Reformers and the rest. And the argument of the Reformers is that growth rates have to slow significantly in order to rebalance the economy. Why? Because investment growth has to slow significantly. And as the charts from my two colleagues have showed you, significant increases in investment are really the only thing that are creating significant GDP growth rates. So if you reduce investment growth sharply, then it's almost certain that GDP growth will slow sharply. So the question then is, well, why do that? Why don't we do the things that we need to do to raise consumption, keep investment growth rates high, and somehow rebalance at very high growth rates? And the argument against that is because as long as we continue high levels of investment, it's going to be impossible to get consumption rates to grow quickly, because those very high investment rates are probably being misallocated on a tremendous scale. And one of the consequences of long periods of misallocated investment is rising debt levels. And in fact, we're seeing very rapidly rising debt levels in China. Now, both my colleagues had mentioned, and particularly Steve had shown the chart of loan growth. And I have to say, we have to make a correction there, because if you look at renminbi lending as the measure of credit expansion in China, you're going to miss something very important that occurred. And that is that the PBOC published a report, I think something like 3 weeks ago, where they talked about a different measure of credit. They called it total social financing. And basically it means all the various ways in which bank lending and bank credit grows. In the past, they had only looked at renminbi loans, and renminbi loans in 2002 accounted for something like 92% of total social financing. Last year, it accounted for only 56%. In spite of massive growth in the lending rate, the other aspects of lending grew much more quickly. And so what we saw actually that in 2010, banks extended not 20% less credit than 2009, which everyone agrees was just astonishing and unacceptable. They actually extended, according to the PBOC, about 2% more of new loans in 2010 than in 2009. What happened is that as they put restrictions on renminbi lending, the banks did exactly what you would expect them to do. They expanded lending very rapidly outside of the quota system. The thing that we're all most worried about is something called the bankers' acceptances, which exploded from almost nothing to something like 16% of total bank credit. I won't go into that, but for those of you who are interested, it's a really good idea to keep an eye on that because there's some very worrying things happening in the bankers' acceptance market. But the argument then is that all of this very rapid misallocated investment is leading to rising debt levels. And the problem with rising debt levels is that they have to be made viable. And the way you make them viable is through transfers of wealth from the household sector. In other words, you've got to keep interest rates extremely low in order to keep debt levels viable. So the argument is that as long as we have rapid increases in investment, we're going to have rapid increases in debt. And as long as we have rapid increases in debt, we're going to put downward pressure on the growth of household income. And if that happens, as I think we all agree, it's going to be very hard to see how consumption is going to grow as a share of GDP, because the key is not many of the things that we hear the Chinese love to save, et cetera, et cetera. The key is that household income is such a low share of GDP. And in order to get household consumption up, you've got to get it to go up very quickly. Now, there are several measures, and some of which Steve Barnett mentioned, being used in the hopes of raising the household consumption share or reducing overall savings. And these measures have been talked about for many years. I'm going to mention 4 of them: improving the social safety net, increasing the size of the service sector, improving the financial sector, especially in its capital allocation, and finally, a plan which the Ministry of Commerce said would be released next month, a 5-year plan for raising household consumption. There is some information about what will be in that plan. And I'm going to argue that none of them are going to work significantly, or they're simply not going to be exercised. First, a lot has been said about the importance of the lack of a social safety net as an explanation for very high savings rates in China. I've always been a little bit skeptical about that argument because I see no evidence around the world that there is a correlation between high savings and a weak social safety net. Certainly, if one believed that, one would predict that Americans save more, for example, than Europeans, or that certain African countries have very high savings rates, or that countries like Singapore or Japan would have very low savings rate, Japan back in the 1980s. I'm a little bit uncomfortable with that argument. For me, the key is how the social safety net is paid for. And if the social safety net is paid for out of income that is not derived from the household sector, then I believe it has a positive impact on consumption because that genuinely raises household income. If it's paid for by borrowing from the household sector at extremely, extremely low rates, even negative real rates, or if it's paid for in other forms of transfer from the household sector, then to me it has only a marginal insurance effect, a small insurance effect, but it's not significantly going to affect overall consumption. So to me, that's the key issue. And in the past, there has been a very little impact on consumption of improving the social safety net. In fact, as you know, every single year it keeps getting lower and lower. The second issue is increasing the size of the service sector and secondarily increasing SMEs. SMEs, small and medium enterprises, tend to be far more labor intensive than SOEs. And there, I am also, I think, a little bit more pessimistic than Peter. The service sector is growing, but from a really tiny base. We're going to have to see it grow significantly more before it makes a significant impact. But one of the things that we are seeing is that the SMEs are getting squeezed out of the market, partly because the financing cost for them is so high relative to SOE, state-owned enterprises. Small and medium enterprises may be borrowing at costs of as high as 30% or more annually. They're extremely efficient, but it's very difficult for them to obtain cheap financing. And this is anecdotal. We don't have the numbers yet, but several of my Peking University students come from wealthy manufacturing families, and they've all told me, without exception, that their parents are having real trouble retaining workers because the workers are, even with rising wages, because the workers are moving to SOEs. So I'm worried that there may be a squeeze, a continued squeeze on SMEs and maybe the service sector in the next couple of years. The The third thing that we've all been discussing and that we all agree will significantly improve the rebalancing is to improve the financial services, to improve the financial markets, reform the financial markets. There, I'm deeply pessimistic. I've been in China for 9 years, and certainly during those 9 years, we've been talking about financial sector reform, and this may be a bit of an extreme position, but I would argue that there hasn't been any financial sector reform at all in China in the last 9 years. In fact, if anything, we may have gone backwards. And the reason I say that is because, to me, there's only two meaningful reforms of the financial system. Everything else is dressing. The two meaningful components of reform are, one, we've got to liberalize interest rates. As I think everybody here agrees, extremely low interest rates are one of the fundamental causes of the imbalance in China. It is absolutely vital that interest rates be liberalized. But the problem is that the more debt we build up, the more difficult it is to liberalize interest rates. In fact, if there were any move to liberalize interest rates today, the local and municipal government borrowing vehicles and most of the SOEs would immediately experience significant financial distress. They are addicted to free capital. And that's why there's really no attempt to liberalize interest rates. The PBOC every once in a while says we're moving towards liberalized interest rates. I don't believe it. It's not a PBOC decision anyway, it's a state council decision. The second aspect of reforming the financial system is corporate governance reform. In other words, banks have to make lending decisions based on economic factors. There was some talk until about 3 or 4 years ago that indeed was happening. I was very, very skeptical. I didn't think that was happening based on conversations with bankers. But certainly the experiences of 2008, 2009, 2010 have made it very, very clear that there is no corporate governance reform. Xiaogong, the chairman of Bank of China, in what I thought was an astonishing article in China Daily last August, basically said that. He said, look, we have this wonderful machine here. Deposit rates are extremely low. Lending rates are low, but the spread is extremely high. There is no credit risk. It's all socialized. That's why banks are in a hysteria to increase lending. It's free money. And certainly he didn't seem to indicate that that's changed. Until that changes, there is no meaningful financial sector reform. And I don't think that's going to change in a hurry. So the last thing that I would mention is administrative means to raise household consumption. So I mentioned that the Ministry of Commerce announced this new 5-year plan to raise household consumption. It's going to be a failure. I haven't read the plan. I've read aspects of the plan, and it's going to be a failure. Why? Because the problem with household consumption in China is an income problem. It's not an administrative problem. We already tried administrative measures. 2 years ago, we decided we desperately needed to raise household consumption. So what did we come up with? We came up with the brilliant idea of subsidizing automobile purchases and white goods purchases. And so what happened? What happened was totally predictable. The sale of automobiles surged. The sale of white goods surged. And other consumption didn't. And so the net impact was that household consumption actually declined a little from what already seemed like an impossibly low level as a share of GDP. Much of what we're seeing, what we think we're going to see in this new 5-year plan, is more of the same. They're talking about improving e-commerce. They're talking about improving retail distribution networks. There is even something about there in improving the quality of advertising. No, none of that's going to matter. What matters is household income. That's got to go up. And to raise household income is very, very difficult as a share of GDP because it is transfers from the household sector that have generated so much growth. Transfers in the form of an undervalued exchange rate, in the form of slow wage growth relative to productivity growth, which in the last year has indeed changed, and hopefully that'll continue. And finally, and most importantly, in the form of extremely low interest rates. When you look at what is the correct level of interest rate, don't assume that a zero real interest rate is the right level. So when an interest rate, for example, when the real interest rate is -2%, that doesn't mean that interest rates are 2% below the correct level, right? A zero real rate is not a real rate is not the normal interest rate in any country. If you want to stop the transfer of wealth from households who are net depositors to banks and borrowers, the nominal interest rate has to be up pretty close to the nominal GDP growth rate. That's the standard you have to look at. Anything less than that implies a massive transfer of wealth from the household sector. So in order to bring interest rates to the correct level, wherever that is, they would probably have to go up not by 100 or 200 basis points, but probably 400, 500, 600 basis points, a significant amount, which is not something that China can do in a hurry. So what the reformers are arguing is that the way to force through the rebalance and the adjustment is going to require a significant reduction in those transfers. And one of the most important ways of removing the need to make these transfers is to stop misallocating investment. And unfortunately, the only way to stop misallocating investment in China seems to be to slow investment growth tremendously. And if that happens, growth rates will slow down. Now, are the reformers winning the argument? No, not at all. They are about as popular as anybody who brings bad news is. Everybody agrees on the goals. You will find absolutely no disagreement with the goal of raising the consumption share of GDP. The problem is there is a huge disagreement as to whether or not China is willing to take the cost of raising the household consumption share of GDP. The good news is that we believe that the two of the whom we believe will be the new members, Li Keqiang, who will probably be the next premier. We say probably because there's nothing formal, and Wang Qishan, who will probably be the next vice premier, and between them will be responsible for economic reforms. There have been very strong rumors that they agree with this approach, that they agree that the imbalances have gotten out of hand, and that they agree that we need significantly to reduce investment. In fact, there were very strong rumors that Li Keqiang, I think it's beyond rumors now, that Li Keqiang was behind the interest rate hike, something that was stubbornly fought by many people, including, obviously, SOE heads who depend on very low interest rates and local and municipal governments. So what we're all trying to figure out, what we're all trying to guess is when will the adjustment take place? Will it take place with the new leadership in 2012? Will there be a difficult succession struggle, in which case it may take a little bit longer? I'm not really sure. My only prediction is that when they release the new plan to raise consumption, if they don't accompany that with a significant reduction in investment, and that means much slower GDP growth, after about 2 years, we are probably going to come to the conclusion that it's not going to work. And by then, I suspect that there will be a much greater consensus and much higher debt levels, unfortunately, that China needs to make the adjustment via a reduction in investment. So that's a lot of stuff, and I'll stop there, Doug, and maybe we can discuss that.
Thank you, Michael. That's absolutely terrific. You've joined the debate and got us thinking in new ways about what we've been hearing regarding the Chinese economy. I want to first give Steve and Peter a chance to respond. You want to go ahead?
Sure. I think that Michael's presentation was useful to highlight the kind of complex problem of rebalancing will be. It's a very complicated engineering problem that's going to require action on a bunch of different fronts simultaneously. I don't think action on any one front by itself will be enough, so there needs to be the financial sector reform that he talks about. If we look at how do you discourage investment and encourage consumption, or how do you develop the service sector? Well, if you have changes in relative prices, if pollution, energy, water, if these things are priced differently, maybe you would see a change in investment. As the service sector gets bigger, households will get a bigger piece of the pie. That's what we know from international experience. So it's sort of a complicated problem where we need progress on a bunch of fronts at the same time. Maybe on two more minor things. In the current account surplus in 2010, maybe I should clarify. Indeed, there were some revisions to the data. So it does seem that the current account surplus in 2010 sort of was stronger than we would have thought, as Peter was hinting at. Basically, they've now started to include the income on foreign direct investment. And this is in the 2010 data, but it's not yet been revised backwards in 2009, 8, 7. So as you revise that backwards, you'll see that the current account surpluses historically were smaller, and that when you compare 2010 to 2009, you'll actually see a sharper increase in the current account surplus. That's our conjecture once the data are revised.
Peter?
Since there's much less difference, I think, between the thrust of Steve's presentation and mine, I'll focus mainly on Michael's. He makes very important points, and it's hard to disagree that these have to be looked at. Only time will tell, I think, what the weight of these various arguments will turn out to be. If I understood it correctly, Michael, your central point is that an effective rebalancing will require a sharp reduction in financial repression. That means sharp increases in the real cost of money. That will then generate a debt problem that will prove to be an obstacle to pursuing the rebalancing objectives. If that is indeed the central argument, we have to focus on how serious these debt problems are likely to be. And I don't deny for a moment that we have to look at this and be very conscious of it. Current debt levels, certainly the official reported debt levels, are very low in China. We all know that there is significant contingency debt in the public sector, but even if you include all of that, all the hidden guarantees and so on, still, even the most pessimistic estimate stays below 100% of GDP. 85% is the best estimate I can come up with. The official government debt is only 20% of GDP. Now, at the SOEs, that may be a more serious problem. I don't know what the debt equity ratios are on average for the public sector enterprises. Undoubtedly, the debt proportion of their financing will have increased in recent years. So if we want to be serious about that, we have to do a lot of homework. And I don't have all the information at my fingertip. Household debt, which was, I think, the key problem in the United States when the housing sector declined, is certainly not yet a problem in China. It's very, very low. Total household debt is somewhere between 30 and 40% of GDP. In the US, it was 130% of GDP when the crisis hit. So we have some way to go, I think, before household sector debt will become a problem in China. But I admit that the SOE debt may be a more serious issue. I just don't have the number at my fingertip. So I admit that we have some research to do. And the other point, that the spanner in the wheel of rebalancing, that SMEs will be squeezed out of the system by higher cost of money, that's another important point. But I haven't seen any evidence of that yet. SMEs haven't had access to the official government-sponsored financial sector for a very long time, and yet they have been growing like gangbusters, in spite of the fact that most have to finance themselves on the informal money markets, where they pay 10, 15, 20%. So that's nothing new. I'm sensitive to the argument, the anecdotal evidence presented to Michael by his students, that many people who are in this world complain about the higher cost of money. But if you look at the Chinese statistics, the SME sector and private employment in that sector is growing like crazy, up till at least the end of 2009, for which we have information. So I'm not convinced at this point that the SMEs will be squeezed out of the system at all. I think they've been coping with very high cost of money for quite a long time. On financial sector reform, I think Michael is, I think we all know that financial repression remains a key feature of the whole system, and that the hidden extraction of resources, wealth from the household sector to the public sector is an important feature of the Chinese economy. No question that that is true. But I must say, his statement that there has been no real financial sector reform in the past 9 years, I cannot really agree with that. If you look at the Chinese financial sector 10 years ago and now, it's a world of difference. The quality of management in the banks, I think, has vastly improved. All of the major banks are now listed. Many of them have foreigners on their boards. They are audited by international auditors. They never were. When the whole reform started under Turangi in '99, none of them had been audited by international level auditors. Now they all are. They all publish their reports. They have to, by Hong Kong requirements and by Shanghai requirements. I think there are many, many remaining problems, but to suggest that there has been no effective financial sector reform, in my opinion, goes much too far. Thank you.
Michael, do you care to respond before we open the questions?
Yeah, just on the issue of reform, I know that's a very dramatic statement, but to me, getting listed is not in and of itself a financial sector reform. It's a step that gets you towards where you want to be, which is to, an improvement in the allocation of capital. Setting up credit committee. In and of itself, setting up a credit committee does nothing. Allowing the credit committee to make credit decisions is why you set up a credit committee. And there it's very unclear that any of those things have happened. So it seems to me that a lot of the reforms that Peter are mentioning are the things exactly that I would call window dressing reforms. The proof to me would be in the pudding, and that is, has there been an improvement in the capital allocation process? And if the answer is no, then I would say then there has been no meaningful reform. Everything else is a side issue. And I think it's very hard to argue that there's been improvement in the capital allocation mechanism. Certainly anecdotally, the bankers will tell you that lending decisions are still made for reasons that have nothing to do with credit. I don't know how deeply I can go into this, but a foreigner had been put in charge of the credit committee of a very important bank in China prior to its IPO. And that was an indication of an attempt at bringing, quote unquote, Western credit standards to the bank. And I had a number of conversations with him, which were incredibly frustrating for him. And finally, he resigned before the IPO. See, I'm afraid to say too much, but the long and short is he resigned because he said he was the head of credit committee and he had absolutely no say on making credit decisions, that the credit committee did nothing. It was simply there because they needed a credit committee for the IPO. Now, I don't want to make too much out of an anecdote, but we hear these stories repeated. But again, I will say the proof is in the pudding. If there has been an improvement in the capital allocation process in China over the past decade, then I would argue whether or not they have adopted Western standards or not is irrelevant. In that case, there has been corporate governance reform. There has been real reform in the financial sector. If there hasn't been improvement, then there hasn't been any real reform. There has been window dressing. So we can agree to disagree. I'm sure we'll both agree that whether or not there's been reform, it's not been quick enough. Then the other thing I would say about debt, and yeah, that's the million-dollar question. There are high levels of debt. We are constantly finding new areas of debt. So my friend Victor Schur last year came up with his astonishing count of local government financing vehicles, which caused shockwaves, but has now been widely accepted as correct. We know that these local government financing vehicles are barely solvent. The CBRC itself said so, and wouldn't be able to tolerate any rise in interest rates. We know that SOEs, there was a recent study done by a Chinese think tank, it came out last month, that said if you added the total direct subsidies given to SOEs over the past 8 years, it was slightly greater than the total profitability of the SOEs over the last 8 years, which suggests that without direct subsidies, SOEs are value destroyers. Maybe there could be externalities, but they didn't include a significant measure for the interest rate subsidy. and a study done by the Hong Kong Monetary Authority 2 years ago suggested that if interest rates were 400 basis points higher, which I think is the absolute minimum to get to a reasonable interest rate, that would account for 400% of the total profitability of the SOE sector. So basically, you can't raise interest rates, otherwise the SOEs will end up losing tremendous amounts of money. You can't raise interest rates because the local financing vehicles will suffer tremendous financial distress. We all know that local and municipal financing next year is going up because land sale revenues are likely to go down. Part of the 5-year plan is that credit will be extended for quote-unquote affordable housing. I don't know if debt levels are too high or not. What I do know is that everywhere I look in China, all of us have this problem, we see new sources of contingent liabilities. For example, the PBOC. Would you believe it if I told you that the PBOC is a big problem? They're actually probably insolvent. These rumors came out about 1.5 years ago. There's tremendous fights between the PBOC and the Ministry of Finance over this issue. Now, why would that matter? The PBOC is sovereign guaranteed, probably. It matters because any increase in interest rates or any increase in the value of the currency increases the net indebtedness of the country because of the PBOC. Remember, the PBOC has got a massively mismatched balance sheet. So a 10% increase in the value of the renminbi increases the net indebtedness of the Chinese government by slightly over 5% of GDP. Everywhere you look, there are these potential contingent liabilities. And one of the things I learned as a trader, I used to trade the old defaulted debt of Latin America, it's the contingent liabilities that kill you, the contingent liabilities that occur, for example, in an economic slowdown. And that worries me a lot. Again, I don't know if there is too much debt, but I do know it's rising very quickly. And I also know, looking at the cases of other very successful investment-driven growth, the Soviet Union in the 50s and 60s, Brazil in the 60s and 70s, much of Latin America in that period, Japan in the 70s and 80s, the Asian tigers up until the late 90s. In every case, they were unable to shift the development model to a lesser focus on investment. In every case, debt levels rose significantly, and in every case, they had a very, very difficult adjustment period, a lost decade or so. That doesn't mean it has to happen in China, but I think the concern among the so-called reformers, who tend to be grouped around the PBOC, the CBRC, the National Bureau of Statistics, and some of the Shanghai institutions, is that if we haven't reached the point where debt levels are too high, we're moving in that direction. And when debt levels are too high, you cannot raise interest rates without causing a significant increase in financial distress. Sort of a long-winded answer. But those are the things. I mean, I think Peter and I can disagree on the amount of debt, but I think we would both agree that if we see continuing increases of debt at these very, very low interest rates, at some point it does become a serious problem for the development model.
Thank you. Thanks very much, Michael. We have a terrific audience here, and I want to get to questions from all of you. I'm going to abuse my privilege just to ask the panel to push the envelope a little bit on what I'm hearing from all of you is a China that's going to grow a lot more slowly. And if you go and talk to the private equity firms and the investment banks in this country, they're all telling their investors that the future of growth is going to be China, Brazil, India, and not going to be here, not going to be in Europe. What are the implications, if I'm drawing the right connection, for our growth?
U.S.
U.S., Europe.
The implications of what, a slowdown?
Yeah, slow down in China.
I'll take a stab at it, although it's difficult enough to talk about China without talking about other countries. One of the things that you often hear said is that China is the great engine of global growth. And I think that's a mistake. China is the highest component of global growth. That's just arithmetic, just like Japan was the highest component of global growth at the end of the 1980s. To me, an engine of growth is a source of demand. What the world really needs is demand. Demand growth is going to be very slow. It's not just the Chinese who have to clean up their banking systems, which means the household sector will clean it up, but it's also the United States has to pay for the cleanup of the banking systems. If you think I'm pessimistic about Europe, you should hear me about China. You should hear me talk about Europe. Europe is massively bankrupt, and the European households are going to be cleaning up the banking system for a long time. Japan is still cleaning up its banking mess in the form of government debt. And throw in the UK to round off the top 5 economies. For me, the problem is demand. And China is not a provider of demand. It has the biggest negative net demand in the world. It's got a huge current account surplus. So the real question about what will happen to the rest of the world if Chinese growth slows significantly is, if we talk about the world in the aggregate, then the question should really be, is that growth accompanied with a real rebalancing, in which case the current account surplus contracts as a share of global GDP? That's positive for the world. If it occurs with an expansion of the current account surplus, I would say that would be a drag on global growth. And the interesting thing to me is that if anybody had been foolish enough in 1990 to predict that Japan would have 0% growth rates for a decade, if he wasn't immediately thrown out of the room for being so stupid, people would have said, if you're right, global growth is going to collapse because Japan is the engine of global growth. And global growth didn't collapse. There are many reasons why it didn't collapse. But Japan didn't end up acting as a major drag on global growth. And I would argue it's because if you look at the current account, Japan genuinely rebalanced. It rebalanced at a very low growth rate, which is typically how investment-driven success stories rebalance. It rebalanced. And as it rebalanced, the current account surplus in Japan came down. Not so much came down as a share of the Japanese economy, but remember that Japan was something like 17, 18% of the world in the early 90s. And last year it was overtaken by China at around 8 or 9%. So Japan's current account surplus as a share of GDP contracted significantly, and that probably was a minor reason for the good growth in the 1990s. I don't think it acted as a drag. So I would say the real question is, how does China rebalance? Does it rebalance? What happens to the current account? Having said that, what may be good in the aggregate for the world is not necessarily good for everybody. I go to Brazil a lot, and I have to tell you, I don't recommend that you're long Brazil for the long term. I think commodity exporters, non-food commodity exporters, are going to have a very difficult adjustment when China adjusts.
Stephen?
Maybe I can be a bit more of an optimistic voice on this. We have China growth over the medium term still at 9.5%. So and if we look at some of that is, so, out to 2015, 2016, we're still seeing real GDP growth of 9.5%. If we look at, one of the big drivers in growth in China is urbanization, and that process is less than half complete. You still have a predominantly rural society. So there's still a lot of kind of domestically led drivers of growth. And if we look at some of the concerns expressed earlier about the financial sector, debt levels and SOEs, and maybe we have a slightly different view. I think clearly the financial sector has been reforming and has been commercializing. But given the current incentive structure, the commercialization of the financial sector suggests you should lend. You have a guaranteed margin, you have high liquidity, you have good capital adequacy ratios. I would lend. So that they are responding to the commercial incentives.
Credit risk.
Yeah. So I would fully agree that interest rates should rise, and that would then that's the right way to go. And on this question of debt and debt dragging down growth, corporate sector in China is a bit complicated. If you look at their deposits, I forget the exact number, but it's over 75% of GDP in deposits in the banking system. So there's a tendency to look at one side of the balance sheet and not the full balance sheet. Corporates have a lot of cash deposits. Corporate sector have a lot of assets. So the kind of corporate balance sheet as a whole may be much stronger than we think. And the corporate sector, including SOEs, are very, very profitable.
Thanks very much. I'm going to turn to the audience now, and I'll ask you when you are identified, please give your name and affiliation.
Thanks a lot. Carl Delman, Georgetown University. Great presentations. I just wanted to follow up a little bit with Michael's scenarios. On the one hand, you're telling us that it's going to be really hard for China to rebalance because of all the problems of the high interest rates and the corporate sector, the debt, the government, all of that. And on top of that, it's also if the growth is slowed, like you're saying is the easiest way to do it, there's going to be a political stability problem because there'll be unemployment. So that doesn't look too feasible. So the alternative is that they're going to continue with this imbalance with large surpluses. How is that going to affect reaction from the rest of the world in terms of possible protectionism against China? And how do you see that working out? Because you're giving us a dilemma which, on two horns of it, I don't see any out. And I just wonder if you could extrapolate a little bit on that.
So I guess the question is about the external balances, but I want to question one assumption. That's another thing that most people say, that if growth slows down significantly, we're going to see a rise in social instability. I'm not sure I agree with that. Again, let's go back to Japan. Had, again, anyone been foolish enough to predict what happened, not only would the world have said that, not only would most smart people have told you that world growth would have slowed down, they would have also told you that there would have been political instability or at least political anger in Japan. And none of that happened. They didn't even remove their leaders until God knows how long they'd been growing at 0%. And so then the theory developed, well, that's because the Japanese are remarkably docile, which I just find that so idiotic. I think there's another reason. If you look at, people don't measure their wealth as GDP per capita, right? You measure your wealth in different ways. Maybe household consumption is a better measure of how you feel about your wealth. And if you look at household consumption growth, before 1990, household consumption grew much more slowly than GDP in Japan, typical unbalanced investment-driven economy. After 1990, household consumption growth slowed a little. It grew much faster than GDP growth. In real per capita terms, it probably slowed not so much. Maybe it went from 5% to 3%. I don't have the numbers. But you can look at household consumption growth, and it continued every year after 1990, even when GDP growth was 0. So remember what rebalancing means. Rebalancing means, in the case of Japan and China and all of these economies, it means shifting wealth from the state sector to the household sector. And if that shift in wealth occurs, you can tolerate much slower growth rates without necessarily making the people unhappy. So I'm not a big believer that we're going to see civil war or revolution in China. If they do the rebalancing correctly, the household sector will be reasonably happy with the rebalancing. The external environment is a very interesting question because I already mentioned peripheral Europe, and I think sometimes we forget that there were two big sources of deficits in the world, the United States and peripheral Europe. Peripheral Europe had deficits of roughly 2/3 the size of the United States. And if you're going to have surpluses, you need deficits, right? They have to balance. So to me, it's very intriguing what's happening in Europe because if you run a current account deficit, you have to have a capital account surplus. Will Spain, Portugal, Ireland, Greece, all the names, will they continue to have capital account surpluses? Well, I was born in Spain. I grew up there. My mother owns a business there. And, a week ago, she called me up and asked me, she said, my financial advisor has been telling me she has a bunch of money. She owns a business, but she also has a bunch of money sitting in the bank. And he says, we should take those out and put them in Germany. And I said, your financial advisor is not a dumb guy. Basically, what they're worried about is growth in Spain and the possibility of Spain leaving the euro. By the way, I believe that possibility is extremely high. But maybe I'm wrong. As long as people believe me, or as long as some people believe me, we run the risk of seeing peripheral Europe suffer capital outflows, in which case they're not going to run current account deficits. They're going to run current account surpluses. So for me, what does that mean? That means that the net European surplus, which consists of a huge German surplus and huge deficits in peripheral Europe, is going to surge. And that means something has to balance it. And basically, there's only two balances. One balance is that the US current account deficit surges to make up for the Europeans. And the other is that the surpluses of Japan, Germany, and China contract very rapidly. I don't know what it will be. That, to me, is a political question. Will the Americans tolerate a surge in the current account deficit? I don't know. Maybe the earthquake in Japan has created a little bit of relief because Japanese investment should soar. And if Japanese consumption doesn't drop, maybe we will see the Japanese current account surplus come down and take up some of that space. But it still is a really big problem. I don't know how the world rebalances without either political problems in the US or current account surplus problems in China.
In the fifth row, young lady.
Thank you so much. Hi, I'm Stella from Johnson & Johnson, and I graduated from Peking University.
Smart lady.
Yeah, oh, thank you. So I have three questions. The first one is very general, like what do you think is the main factor to push the GDP, the growth rate, so high in China generally? So what do you think of this? And the second question is, I think the political mechanism in China is very different from here, as you know. So what have you considered the cost of the investment, the political factor into this cost of the investment? So not only the real interest rate is the cost of the investment, I think some political factors should be considered into the model. So how could you quantify this factor into your model? Have you tried this before? This is my second question. And the third question is, this third question is very specific to the financial reform. So Michael, could you please, or you can tell me later personally, like this financial reform, as you say, that it could be very difficult. Even the president of Chinese bank said it is quite difficult and maybe impossible to get reformed. I think it is mainly because the political mechanism is very difficult. So do you have any practical solutions for the financial reform, the financial system to work more efficiently if the reform is not quite possible? Thank you so much.
Anyone want to? You will address Michael.
I think we would probably all agree that, you know, at the most superficial level, what caused GDP growth is very high levels of investment and a burgeoning trade surplus. But it's primarily investment. Every time there's a problem every time there's a slowdown in growth, they step on the investment accelerator and we get very high growth levels. The political factor is absolutely, yes, it's very important. Much of the investment growth is determined partly by the central government, mostly by local and municipal governments. By the way, you know, the provincial leaders before the National and People's Congress all made their growth projections. Astonishingly enough, they weren't the same as Premier Wen's. Premier Wen predicted 7% growth. They predicted 15% growth in the aggregate for their provinces. So I think a lot of it is driven there. And that's a very big political issue because political power comes from control of the credit system and control of local manufacturing, especially through the SOEs. So I don't want to talk too much about politics, but I would argue that a lot of these reforms have as a precondition some form of political reform. And then the third question, remind me? I'm so jet lagged. What was the third?
Banking reform and politics.
Yeah, I would say it's exactly the same argument. The corporate governance reforms presuppose, I would argue, some kind of political reform. Do I have any practical solutions? No, people always ask me it in a different way. They say, what would you do if you were in the government? And I would resign because being a professor is so much easier. But one thing that I think that if you say it now, people will just say, forget about it, it's not going to happen. But I think in 3 years, we're all going to be talking about it, is probably some version of privatization. Because I think the easiest way to increase household income is not by raising the interest rate, raising the currency, raising wages. If you do it quickly, growth collapses. If you do it slowly, it takes way too long and debt levels build up. So the easiest way is simply to transfer wealth from the state sector to the household sector. There are many different ways of doing it, Perhaps you can sell stuff and use it to clean up the banks. Perhaps you can move stuff over into the Social Security and medical funds. Perhaps you use privatization vouchers. I don't really know. There's lots of ways of doing it. But my only practical solution would be to prepare some way of transferring wealth from the state sector to the household sector. But of course, everyone will immediately say, but that requires some kind of political reform. Yeah, probably.
Peter, Stephen?
Just, if I may, just supplement that one or two comments. I basically agree, but on the transfer of wealth, how critical that is for rebalancing in the future. Allow me just to point out, by way of a footnote, that the transfer of wealth has not been a one-way process in China. Because of the financial repression, we all look at correctly at the transfer of wealth from the household sector to the public sector. But we should not forget that at the turn of the century, 1999-2003, there was a massive reverse transfer of wealth from the public sector to the household sector in the form of the privatization of urban housing in China, which is the world's largest privatization ever, which was a transfer of ownership at a fraction of potential market prices, because there was no mortgage industry, so there was no choice. But the implicit transfer of wealth swamps all the reverse transfer of wealth in the subsequent 10 years. I just wanted to point that out as a footnote. If I may abuse the opportunity, Doug, just to come back to your central question, what does it all mean for the US if China slows down? I think there's one important point that has not been made. I think it depends very much on the quality of the adjustment process in China. If we get an orderly adjustment, a more rapid acceleration of service sector growth and a reduction in the current account surplus, it could all be actually and a rise of surpluses in the European periphery, which would have to compensate for the decline in China's surpluses. It could be beneficial for the US in the long run. In the short term, if China's import growth, which is by far the largest import growth in the world, mind you, slows down, then of course the immediate effect on the trade side is negative for soya growers in the US and some other. I mean, US largest export is crap and soya. So they will suffer. But a potentially even more negative effect, I think, is through the financial sector. If a decline in China's external surplus is not accompanied by a corresponding rise in the surplus in peripheral Europe, then it is very likely that the cost of money will increase very sharply, very quickly, especially in light of the Japan experience in the last few weeks. If Japan's surplus shrinks, or if Japan starts selling off their huge hoard of treasuries, the demand for the market for treasuries will change fundamentally within a matter of weeks. Yields on 10-year treasuries might increase to 5-6% within a matter of weeks, and that would have an enormous impact negative impact on the US.
Thank you very much.
Real quick on the growth question. I think sometimes we look too much at this year, last year. If we step back a bit over the last 25 years, it's really been a phenomenal growth story, and it's really about productivity, getting workers off low productive farms into factories in the countryside, a massive change in productivity, and an unprecedented reduction in poverty that came along with this. And as to the tough question on concrete steps for financial sector reform, I'm glad I'm an economist and not in China having to do these reforms, but I can envisage a set of reforms. You could start with raising the deposit and lending benchmark rates, draining liquidity in the system, then liberalizing the interest rate structures. You can really kind of see a roadmap of sequential reforms that would lead to a much more modern and commercialized financial system.
Thank you. In the second row here.
Judd Harriet, documentary filmmaker. I'd like to ask about the multinational corporations. I have the suspicion that they figure large in China's export growth and also in the transfer of technology. These reforms that you're talking about, could you talk a little bit about the likely impact on the multinational corporate sector in the investment and export picture of China if these reforms take place? What may happen to multinational corporation participation Could you comment on that?
Are you addressing this to anyone in particular?
Maybe to Michael?
I'm not smart enough to figure that out. It's very path dependent. It depends on which kinds of reforms take place. One thing I do know is foreign companies are complaining a lot about the difficulties of doing business in China. And that's gone up quite a lot in recent years. And so I attended a conference with, I think it was the European Business Council or whatever, and they were talking about all the things that made it difficult for foreign businesses to do business in China, regulatory restrictions, blah, 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 blah. What impressed me is that whenever we have countries that have been growing very rapidly through this investment-driven growth, foreigners always complain about the difficulty of doing business in that country. That happened in Japan, that happened in Brazil. I can't say that happened in the Soviet Union because there weren't foreign companies in the Soviet Union, but had there been, I suspect there would have been complaints. And they always come up with very specific reasons. And it's always very different sets of reasons. And my suspicion is that it's probably not that. It's probably something else. That investment-driven growth model with very subsidized capital, I suspect that that's at the root of the difficulty that foreigners have in doing business in another country. I can't really prove it. It's just an instinct, because in every country that we've seen this kind of very rapid investment-driven, especially through financial repression, growth, foreigners always complain about the difficulty of doing business. So that's not a very concrete answer. I apologize. It's a way of maybe hiding my ignorance about what the answer is likely to be.
Maybe that's a good topic for one of your students to work on when you get back to BK. Sin Lee in the back.
Peter wanted to...
Oh, excuse me, Peter. If you wait 1 second.
Again, if I may, just a very short supplementary comment. I agree with Michael on the uncertainty and the lack of some comprehensive knowledge base on that. But I'd like to point out there is a real interesting paradox. There is a decline in the quality of China's business climate for foreign investment, no doubt. All sources indicate that, European sources, American sources. But profits of foreign-owned companies in China are up. They're all saying they're doing extremely nice business in China. And since the FDI inflows are also up, I don't know quite what to make about the deterioration of the business climate.
Dr. Lee?
Okay, thank you very much. And this is Xin Li from Observatory Group. I have two questions. The first one is for Michael, and the second one is for all three panelists. And so the first question is, Michael, you have described to us now a very dire situation in China in the coming years. Basically, this is a much slower economic growth, and combined with a potential banking crisis. And this is a hard landing scenario. So
I'm sorry, what scenario?
Hard landing.
Okay.
Yeah, so I think it's very difficult to get the timing right, but I still want to know if in your mind, is there any catalyst or trigger for that crisis scenario to happen in China? This is the first question. The second question is about China's exchange rate. It's quite unusual to me that in any China event held in a DC-based think tank, that the RMB value is not discussed as a major theme. So if what Michael has described is closer to the reality in China, the current value of RMB is, to me, it seems like it's overvalued. It's not undervalued. So I just want to know if you, have any view on this. Thank you very much.
I'm so jet-lagged, Shinshin, I forgot your first question.
So
hard landing.
Hard landing,
right.
the trigger or catalyst for the hard landing to happen in China, or is there any timing in your mind?
First off, Shinshin is one of the guys that I always read. I find his stuff really, really useful. I'm going to steal a phrase from Nick Lardy. It's not a hard landing, it's a long landing that I think is going to happen. I don't think there's going to be a crisis in China. I think there's going to be a long period of slower growth in which the excesses are ground away. There are a couple of things that could cause a hard landing. For example, if inflation soars, which I don't think it will, but if inflation soars to very, very high levels and persists, and if there is a perception within the state council that the typical measures they've used to combat inflation aren't working, then I think we could see a hard landing, because high levels of inflation make difficult monetary management almost impossible. Again, I don't think that's going to happen, but if I'm wrong about inflation, that could be a significant issue. If there is a really, really nasty trade war, again, I don't think it's going to happen, but if something were to happen on the trade account, which would force China's current account surplus to come down as quickly as it did in 2008, I remember the chart that I think it was Peter showed us, where we had growth in the first quarter of 2008 of something like 14%, then 0 in the first quarter of 2009, and then back up again. That shows how important the current account was. If we saw something like that happen, I think you could get a hard landing, although again, I think it's not a high probability. The only brick wall, to me, is once debt levels become perceived as unsustainable, because when that happens, you get systematic disinvestment. I don't think we're near that brick wall, but if we ever do get to that brick wall, if we ever do get that perception that suddenly everywhere you look there's debt and there's nothing that can be done about it, then we could get a hard landing. But again, I think that's several years away. My guess is that we're going to slowly move towards a recognition that the current growth model, this is not to put too fine a point on it, has to be abandoned. And that's going to be a slow process, because I don't think there's simply going to walk away from it. And that's probably a political question. So I'm not going to tell you what I think, because all I think is what my smarter friends tell me. But there are two possibilities. One is that when the new leadership comes in, because they're very concerned about the growth model, they'll move quickly to adjust, because what they want is to get the adjustment out of the way before 2017. And then another group says, no, they can't move quickly to adjust, because that requires complete consensus within the Standing Committee and probably within the State Council, and it's not going necessarily to be an easy adjustment. It could be a difficult political adjustment. I'm not smart enough to tell you which is more likely, but those are the sort of two scenarios that I find plausible.
I thought I was going to survive a whole session without mentioning the exchange rate. We continue to see the exchange rate as being substantially below the level consistent with medium-term fundamentals. And I think the key is exchange rate's one part of a comprehensive package to rebalance the economy. But obviously, if we look at the exchange rate, that a more appreciated exchange rate would help with things like increased household purchasing power. It would help increase labor's share of income. It would help reorient investment towards the non-tradable sector. So clearly, it's an important part of the rebalancing, but it's just one part of a much broader package of reforms.
Way in the back.
Hi, Joshua Wu, U.S. Department of Commerce. I'd like to ask a question about the SOE sector. To what extent do you think that SOEs influence central level policy? And is that sort of a sector that has been overlooked in terms of their role in what the central government does? And also, to what extent the SOE sector is reforming on their own? Are they a monolith, or are there different sectors breaking out within the voice of SOEs? Thank you.
Anybody want to venture a comment?
I'm hardly an expert on that subject, but since my companions were silent, allow me to make a few comments. Nobody really knows, I think, what the performance is of China's SOE sector. From a purely accounting point of view, they're doing extremely well. If you look at the profits of the holding companies, SASAC at the central level and lower SACs, I mean, they have profits of 150 billion after tax dollars. I mean, this is incredibly profitable. If SASAC Beijing were a commercial incorporated holding company, it would be by far the largest company in the world and the most profitable. But these are accounting numbers. There are all sorts of things underneath that we don't necessarily have a full picture of. There are undoubtedly massive hidden subsidies in the form of a repressed lower interest rates to the state-owned enterprises, quasi-monopoly positions that are granted by the state, and other factors that inflate the accounting results. The only other comment I would make is that even though we don't know really how to assess fundamentally the performance of this sector in the economy, it's probably true that they're doing a lot better than 20 years ago. The key change, what makes things so hard to assess, is that in the late 90s, actually from the late 90s onward, all these state enterprises were relieved of their social burdens in China. One of the reasons why almost all of them were not profitable in the 1990s was they were responsible for healthcare, for education, for the cemetery plots, for the swimming pools, and for the housing of their employees. All these social burdens were shifted out of the enterprises to basically the public sector, and that improved their cash flow enormously, especially the housing privatization. That was probably the single most important factor, improving the accounting profitability of the enterprises. But how good they would be if they were facing truly competitive international competitive conditions and a true cost of money, I don't think anybody is in a position to say with confidence.
It's interesting that they don't surrender themselves to competition. So presumably it works better this way than the alternative. Question back here in the middle. The red tie, yes, please. Thank you.
Thank you. I'm Wang Qi, a counselor with Chinese Embassy. Thank you very much for your wonderful presentation and your deep study of Chinese economy. I learned a lot. I first make a quick comment and then I'll ask question. Chinese government has made a great efforts in restructuring economy, and I believe made significant progress. Last year, China's domestic demand increased by about 17%, highest, as I believe, among all major economies. And the share of trade surplus to GDP has been cut by half during the past 3 years. And just panelists mentioned that China just passed the 12th five-year plan. The theme of plan is to further speeding up the economic structuring. Key points including to further develop domestic demand, to develop service sector, to further encourage innovation. China also lowered the growth targets to 7% for the coming 5 years, which is much lower than our average growth rate, 10% during the past 10 years. I think the intent is to provide more rooms for economic restructuring. So I think in the coming years, China will continue to advance in economic structuring. My question is about I think there's a asymmetry in the economic rebalancing among all major economies. Some people think that China and some emerging economies are moving faster in restructuring economy than some developed countries. Just as Pete Michael mentioned, some developed economies rebalancing are slow. Many developed economies are facing high debt, high fiscal deficits, and low saving rate. Some people are concerned that U.S. economy might go back to their growth model before the crisis, which is a consumption-driven growth model. So I think if the asymmetry in the global rebalancing growth economy continue, it will hurt the global rebalancing process. So my question is, do you think it's necessary to further encourage some developed countries to speed up their economic rebalancing to create a more favorable condition for the rebalanced economy? Thank you.
Go ahead.
I guess on the global rebalancing, I think every country has a part to play, and that it needs to be a collaborative effort. And we see this in venues like the G20, where there is a collaborative effort. I think in the specifics of China, it's a case where the policies that will help China rebalance will be good for the global economy. Fortunately, are also good for the Chinese economy. There's a kind of a coincidence of interests here, so I don't see a conflict there.
Yes, they do need to rebalance. And global rebalancing can't take place in one country. So yes, we're going to have to see rebalancing in the United States. We're seeing rebalancing in Europe, maybe a little bit faster than we would like, but they are rebalancing, but it all has to occur simultaneously.
We have several hands left. Can I ask the two questioners left to each ask your question, and then we'll get a summary response before we close.
My name is Sabina Dewan from the Center for American Progress. I have a very quick question. We've talked a lot about the implications of a slowdown in Chinese growth on the U.S. What about expanding household consumption in China? How does that affect the U.S., particularly in terms of exports? Do we see China being a new market for our products and services in the future?
And the next question.
Hi, it's Bob Davis with the Wall Street Journal. Peter, you talked specifically about the sort of wild lending that went on that was at the heart of the stimulus plan. And then the assumption always is that this went into infrastructure, but there are other people who say that, in fact, the money to the state-owned enterprises went into real estate, and that it inflated a bubble, which then brings in consumers who think that, in the American fashion, they think that real estate can only go up, even though they're not necessarily leveraged. So what's your, both you and Michael as well, what's your sense as to whether we're at or China is in danger of a bubble that might burst, and if it were to burst, what sort of implications would that have?
Please.
You want to? On the first question, what would be the effect on the U.S. if China pushes up the household consumption growth rate? Well, it would be helpful, but in my presentation, I emphasize that the consumption growth rate in China is not the problem. It's the investment growth rate. That's the problem. And rebalancing China's economy may be helped by pushing up marginally consumption growth rate, but when your consumption growth rate is already 8.5% or 9% and has been at that level for 10 years and is by far the highest consumption growth rate in the world, I would not select that as the area to concentrate on for rebalancing. I think, and Michael would agree with that, focus on the investment side. So don't expect China's household consumption growth rate to go higher than it is already. It's already extremely high. On Mr. Davis's question, I think the whole situation in the real estate sector is still very troublesome. I don't quite know what to expect. I agree with you that there is a high probability, almost a certainty, that a large proportion of the sharply incremental lending in 2009 and 2010, money that was meant for stimulus purposes for public sector projects, actually went through the state-owned units, enterprises, into real estate, and often for purely speculative purposes. The situation is highly unsettled. Beijing has been trying for almost 2 years now to cool the speculative fever in the residential urban housing market with very limited success, I would say. Just in the last months, we see for the first time, perhaps as a result of further administrative tightening measures, a slight decline in residential real estate prices in some major cities. But whether that's the beginning of a new trend, I don't know. The situation is fundamentally unsettled. I don't at this point, I'm not really concerned that you will get an American-style collapse, housing sector collapse. That, I think, for all sorts of reasons I have no time to go into, seems unlikely. But the main problem is overpricing of housing in selected Tier 1 cities, which creates a huge affordability problem for first-time home buyers, and that will have social implications. It's almost impossible for newlywed couples or for the husband in the newlywed couple to get an apartment so that he can get the bride. And that's, I think, building up that problem.
Good.
Maybe building on the real estate question, I think we have a very similar view as Peter just expressed. I think the situation in the China housing market is a bit different. I mean, on the one hand, there are these sort of structural incentives to invest in real estate because there's few other alternative assets. So you're going to get pressure coming from that for asset price inflation in real estate. But when we looked, and we have a recent working paper, maybe not that recent now, that looked at the housing market in China, just like Peter said, we saw maybe in some Tier 1 cities there were signs that of asset prices running quite a bit fast. But in many of the cities, actually, they didn't look out of line with fundamentals. And at the same time, I think you've seen the government really take a series of measures to cool the real estate market. I think that the challenge they have, and I should add that the households don't seem highly levered. I mean, there's a very large down payment, and often the actual down payment is much more than the statutory minimum. So you don't have the kind of gearing that you saw in the U.S. But the challenge is the affordability. You need to ensure that there's a steady supply of housing for lower income people. But this has been duly emphasized in the recent NPC meetings.
Well, thank you very much. This has been an excellent panel. I want to really thank my colleagues for their collegial and expert performances up here today and for addressing so many important issues. Please join me in thanking them.